The market crash of 1929 was the worst of all history. 3 years later, in 1932, stocks had fallen over 80% of their original value. Think about that for a second, an 80% drop in your share price. Can you imagine what it would do to your portfolio?
I've got nothing left. Oh God.
At its height, GDP fell by more than 30% and unemployment rose to nearly 25%, and nearly half of all banks in America failed. This crash ultimately preceded a time we now call the Great Depression, which had its effects all the way across the globe and caused huge hardship, pain and suffering. After this event, the financial systems of the world were rocked, trust in banks failed, individuals and companies didn't want to invest any money, and intervention was needed to kickstart the economy once again. The question I wanted to answer in today's video is, could that crash of 1929 happen again in 2021? I'm going to run through quickly what happened in 1929, a bear case for what could happen in 2021, a bull case for what could happen in 2021, and then my thoughts for what I actually think is going to happen. So without further ado, let's get straight into the video. So what caused the crash of 1929? Let's rewind the clock a few years before then to see what actually happened and what led to this event, and to hopefully see if we can learn any lessons from what happened as well. This all started after the end of the First World War, where America entered a period known now as the Roaring Twenties. This was a period of massive economic, social, technological and cultural progress. Spirits were high at the end of the First World War and the US moved into its powerhouse mode. They moved from a wartime economy to a peacetime economy and pumping out everything you could imagine under the sun. Everything was up. Constructions boomed, cars boomed, the average person was earning more, consuming more like nothing else had ever seen before. And there was certainly no end in sight. Films, radio, aviation all saw major advancements that would change the world forever. From a stock market perspective, the only way was up. Everything kept going up. With the strength of the economy behind them and production at all-time highs, the US became the most powerful country in the world. From 1920 to 1929, stock prices almost quadrupled. And just like now, everyone thought prices would just keep going up and up and up. Because it was a sure thing, right? Fear of missing out was strong. People were pouring into the market, borrowing as much as they could, using margin, using leverage just to get into those stocks because the only way was up. The market almost felt like a casino where the house didn't have the edge, but you had the edge. When you walked into that roulette table and spun that ball round, you were always going to win. Unfortunately, we already know the end of this story, and by the end of the decade, the stock market no longer really reflected what the true economy behind it was actually doing. Demand had slowed, companies were overproducing, unemployment was slowly rising, and interest rates were being hiked up to stop people rampantly putting more money into the stock market. Unfortunately, with higher interest rates came less borrowing and less spending, which ultimately led to those declines and didn't really help much. Businesses had less money to invest in, consumers couldn't get cheap loans to get new cars and new stuff for their house, and all of a sudden, America was in decline. One thing completely unrelated that had nothing to do with the crash was not turning the like button blue. If you've enjoyed the video so far, I'd really appreciate it if you could hit the like button for me. It just helps small creators and channels like myself to get our message out there and hopefully entertain some more people. So if you wouldn't mind, I'd really appreciate it. So what's different from 2021 to 1929? That's a long time ago, right? Surely there must have been something different. Surely things have come a long way, right? Well, you're absolutely right. The economy of 1929 looks nothing like the economy of 2021. You can just see that by the type of companies which dominate the stock market now compared to looking back at 1929. Technology companies now completely dominate the market, where before it was steel, oil, and different car companies. Companies like Apple, Microsoft, Amazon, and Tesla replaced those old giants like Standard Oil, Ford, and General Motors. The modern economy is massively more diversified, service-driven, relying a lot less on oil and heavy manufacturing. It's also diversified massively and spread right across the globe. Heavily interconnected, technology has completely changed the way we work and almost bears no resemblance at all to the economy of 1929. From a government and regulatory standpoint, there's also been some huge changes. Before the Great Depression, governments pretty much let the finance sector get on with itself, and unfortunately we saw where that ended. From the 1930s, governments were a lot more interventionist at changing fiscal policy to make sure a crash like 1930 didn't happen again and we wouldn't see another Great Depression. Things like the Securities and Exchange Commission were born in 1934 to oversee and regulate the market to make sure that this couldn't happen again. Also, we had the Banking Act of 1933 brought in. This created deposit insurance and prohibited banks from dealing in securities, meaning that people could feel confident that their bank deposits weren't going to go bust, as everyone had just tried to have a run on the banks just a few years earlier. Ultimately, if the banks don't have enough money in their coffers when people want to go and deposit the cash, they go bankrupt. And of course, once you see that long line outside of your bank, what's the first thing you do? you join the queue and try and get all your cash out. This government intervention of interfering in the markets and making sure they were regulated and more protected wasn't just exclusive to the US, and pretty much was standardized across the globe as people wanted to make sure that the economy and the stock market didn't get too disconnected and we'd never see a depression as bad as we'd seen before. Right, let's look at the bear case. Could the market crash of 2021 or 2022 be as bad as what happened in 1929? There's certainly a lot of people out there that said it could happen. There's no doubt that since the pandemic of 2020, the stock market's had one hell of a ride, jumping up to all-time highs nearly every single day you look at the news or every single week. The falls of 2020 were some of the shortest declines the market has ever seen. In fact, it only took 126 trading days for the market to improve and reach all new time highs after that massive decline. All while in the background, multiple people lost their jobs, unemployment reached a height of 14%, slowly going down to 6% where we are today in the States, but nowhere near those lows of below 4% we were before the pandemic. So how can we have a stock market that's wildly valued so high when the economy underlying is a little bit shaky? Commentators and onlookers are certainly predicting some bad times ahead. Michael Burry calling the current situation famously the greatest speculative bubble of all time on all things. Hashtag Flying Pigs 360. Also, looking back at the charts, stock market recessions have happened typically every 7 to 10 years, and we're 11 years from the recovery of 2008 to 2010, so we must be due one soon, right? Price to earnings ratios are higher than they've ever been before, nearly as much as the dot-com bubble. There's so much optimism and euphoria around the stock market. The returns we've seen in the last year or two have been absolutely phenomenal. No more boring 8 or 10% returns. Now we're talking about 50%, 100%, 400% returns, and that's normal. If we see our stock ticking along, boring, only going up 1% in a day, we need to sell. Looking at other charts like the Schiller PE ratio, as mentioned before, we're getting dangerously close to the potential all-time crazy highs like we saw back in the dot-com bubble, when speculation was completely rife, people lost their minds and lost lots of money at the same time.
Boy, have you lost your mind, because I'll help you find it.
What's that saying? When others are greedy, be fearful, and when others are fearful, be greedy? Maybe 2021 could be that. Looking now at interest rates, and of course they've been kept low for a super long period of time, and we printed more money than ever before. Almost 1 in 5 of all the dollars around were created in 2020 alone. That's pretty scary. And what we typically see with more money is a weaker pound or dollar in our pocket, which means prices rise, which means things seem to cost more, assets go up, houses, price of gold, cryptocurrency, stocks for example, as people try and protect their money from inflation and making sure that they don't lose money. So some things are certainly not looking good right now, but what's the bull case? Well, the bulls would say that 1930s were very different from where they are now. As I mentioned earlier, the economies are totally different. We live in such a different, interconnected, technologically driven, forward-thinking world which is more interconnected than ever before. Industries which didn't even exist before in tech and sciences have helped create a massively diversified economy, whereas before we were relying on some of the old guard, the oil stocks, the steel producers, etc. And now we live in an economy where certain sectors could completely fail while the others can still thrive. Also think of the politics and the governments that have completely changed the financial services sector as we know it. The FCA here in the UK and the SEC in the US have been able to regulate and monitor the financial services industry to make sure that everyone's playing fair, and to also keep a close eye on those markets to make sure they don't get too detached from the economy underneath them. Central banks also coordinate to make sure that we have a sensible inflation rate and things don't get too much out of control. Everyone loves to see a good stable economy because governments love it and they keep bragging about how high the stock market goes. We've also learned a lot of lessons from the past, so now rather than raising interest rates and to stop people trying to borrow and speculate, where it can actually damage the economy, we now react to downturns by keeping interest rates super low, pumping plenty of money into the economy to make sure that we stimulate both a consumer and a business perspective to make sure that we're spending and spending and spending. By pumping more money into the economy, ultimately we're able to spend more, borrow more, get bigger houses, buy the thing we wanted to buy today without having to save up and hold off. And that ultimately means from a company perspective, they're not sat there with huge stock wanting to be sold and they're constantly supplying what we need. Can we really imagine a world or a government or anywhere that would accept an 80% drop in the prices of stock market? Governments around the world would do anything they could to pump money into the economy and make sure that people don't suffer like that. Ultimately, it's bad for them and it's bad for everyone else. I don't think the economy in the modern world in 2021 and beyond will look anything like it did back then, and we're ultimately headed to a more regulated environment where ultimately the stock market is brought under control and a bit more connected to the underlying economy. But no one can predict the future, right? So it Could happen. Here's what I think. Let's ask the question, should we all sell out now and wait for the next crash? You know, people have been saying the market's going to crash almost every single day, probably for the last 400 years. If you could Google quotes of someone every single day, you would find there'd be an analyst at some major investment broker saying that everything's going to crash, they're really pessimistic, and there's a huge recession knocking on the door. We could also go back to Nostradamus himself, cherry pick one of his predictions, and ultimately probably match it up with something that's already happened. The problem with his predictions is he never left any timescales. So given enough time, anything can happen. Remember that funny theory about giving infinite time to monkeys and a typewriter? That given enough time, monkeys could type out the complete works of Shakespeare from beginning to end, just by whacking on that typewriter. Given enough time, anything's possible. Also, from a psychological perspective, us humans are unfortunately programmed to fear losses more than we look at our gains. In fact, it's been proven that we feel the losses of something twice as much as we feel the positive effect of a gain. That's why we look out for negative news stories that talk about market crashes and the world ending. We're always looking for that headline of negative news. We're always very much willing to listen to someone who tells us that one of our stocks we just bought last week is going to go down and he's going to tell us why. Unfortunately, as humans, we are programmed to go after that hysterical and sensationalized newspaper headline that tells us doom and gloom and the world's going to end tomorrow. When in reality, the world hasn't ended and the end of the world has been predicted probably once a year at least for the past 500 years. So I'm sorry to say that it's part of human nature to try and avoid risk and be really negative and pessimistic about your potential stock options, but just be aware of that the next time you see red in your portfolio. Just think about it this way. No one's going to give a TV interview to a guy that goes on and says, you know what, everything's fine, there's going to be some bumps up and down along the way, but the global economy will be fine in the next 10, 20, 30, 40 years, and you should just consistently invest in index funds and you'll be fine. Nobody wants to hear that. They want to get someone on who's going to tell them that the world's going to end and that the stock market's going to decline 30% and it's probably going to happen in the next 2 or 3 months. It gets more views, it gets more clicks. So look, all that said and done, let's go back to some of the fundamentals that we know, that we can control. Number one, you just cannot predict the price of a stock. It is a complete statistical anomaly. It's a complete gamble on any given time or any given hour, what the price of that stock might be. You can't time the market, nor can anyone else. If we could, we'd all be multi-millionaires or we'd be very poor at the same time because we'd all use the same system. Secondly, look, we know there's probably going to be a crash at some point, but we just don't know when it's going to be. Peter Lynch, a famous Wall Street investor, once said that more money's been lost trying to time the market than would have been made. And as Warren Buffett always adds, timing the market beats timing the market all the time. And these guys have been doing this for a very, very long time. Thirdly, you being optimistic or pessimistic won't do anything to your stock price. So ultimately, it has no effect on the price you see going up and down every single day. And finally, knowing everything we do know, we know the market's going to go up, we know it's going to go down, but ultimately there's probably going to be more ups than downs. And if you really don't believe the economy in the next 10, 20, 30 or 40 years won't be larger or more efficient than what it is today, then I think we're going to have some bigger problems to worry about. The 2021 or the 2022 crash could be as bad as 1929? No. I think we're fundamentally different from that position, and I don't think there's many similarities really that we can draw upon to say why that might be the case. I think there's definitely going to be corrections, there'll be recessions along the way. Who could have predicted what could happen in 2020? And I'm sure some other things will come and disrupt the world as we know it, but that's the excitement of life, and I'm afraid we can't get around from that. The only way we can avoid these bumps is by investing for a long period of time, consistently, month after month, as I keep saying on this channel, and lots of other people say the same. Stay consistent, keep to the plan, and stick with it. I hope you've enjoyed the video. If you had, drop me a like, and make sure you subscribe for more. I'll see you guys in the next one. Thanks for joining us.